absolutely. I was intently listening to all the introductions that have been happening just so that I can get a perspective of what are the expectations from the session today. So so this has been helpful.
Okay, awesome. Thank you so much. Yes, stage is yours.
Sure, absolutely. So so what I do is I'll quickly just share my screen, and Jatin, you can let me know as soon as you can see my screen. Since the presentation already includes my introduction, so I just take that as a part of the presentation itself. Is that fine?
Yeah, perfect.
Okay, awesome. So are you guys able to see my screen now?
Yes.
Perfect. So so basically, I prepared this presentation in conversation with Jatin, where just trying to go through all the things that we've done to figure out what are the things that we did to approach investors who invested in my company. So before I get to those steps, I just wanted to quickly share with you a quick introduction about me. So so I did mechanical engineering, and then I worked as an investment banker for about a year and a half. And currently I run this startup called Gridle. At Gridle, we basically offer a customer experience platform or a client lifecycle management platform for agencies and freelancers. So basically companies that are into selling services, which is IT service or design services, digital marketing services, and so on and so forth. Gridle basically helps them manage their client relationships and manage their client lifecycle as well. You can get to know a little bit more about me on my website as well. However, just to give you a quick brief of Gridle as well. So we are about a 40 people team now. We've been around for about 6 years. We raised our first round of investment from CII, which is an Ahmedabad-based incubation center. We raised our second round from a group of 8 angel investors, and then we recently closed our third round, which we'll announce in the next 15-20 days or so, which we raised from a VC firm called GVFL. So so that's kind of very quickly been our journey. And so the rest of the presentation essentially is a summary of all the things that I've had the opportunity to learn over this period of time. Right? So so that's a quick introduction about what I do or where I come from. So this is a very quick overview of the presentation. You guys are able to, so Jatin, just let me know if my screen freezes, right? So, okay.
Yes.
Awesome. So so this is a presentation overview of what are the things that we are going to cover in today's conversation, and then we'll open it up for questions, or even at any point of time, if you have a very specific question, please feel free to write that in the chat window as well, and we'll be taking that after the presentation as well. So we'll talk about how much do you actually need to raise, what are the things that you need to have before you start your outreach activities, what are the basic ways of reaching out to investors, some key things that you should have in terms of thought process, the super hack, and then we'll move on to open up the floor to questions. Right? So that's a very quick overview of what we are going to do today. So so a lot of times, and this is something that we ourselves also did, a lot of times when a startup goes out to raise, their answer in terms of what they're raising, in terms of whether it could be 25 lakhs or 50 lakhs or 1 crore, 5 crore, 10 crores, whatever the case may be, at least at the seed level, it is derived much more out of intuition. Right? So you feel that if you have 50 lakhs in your bank account, there are X, Y, and Z things that you could accomplish. However, that is not the correct way to go about it. Right? So the answer to the question of how much are you looking to raise is actually going to determine how you reach out to your investors. Right? So as an example, and this is something that we'll cover in detail later on, but as an example, if you're raising 50 lakhs versus if you're raising 5 crores versus 15 crores, the audience or the kind of investors that you talk to are very, very different from each other. Right? Their requirements, their needs are also very different from each other. And hence the pitch that you make also has to be very different. So the answer to this question actually determines which persona or profile of investors should you reach out to and what do you present to them. Right? So it hinges on knowing this answer as precisely as possible. So my first ask for all of you is that you first need to figure out how much are you looking to raise and where will that get you. Right? So once you know how much are you looking to raise, then there are 3 key things that I want to talk about before you start your outreach to investors, right? And so that is across assets, connections, and pitch. and we'll look through each one of these in a little bit detail. So the first is, what are the assets that you need to have before you start your outreach? And so here's a quick list of assets. So pitch deck, obviously, you need to have financial projections, because that will actually tell you how much do you need to raise. If you already have tractions, then you need user histograms, essentially slicing and dicing your user behavior on the product platform. In some cases, it could be revenues. In some cases, it could be customers, whatever fits in your case. If you have traction, then you need to have histograms of all of those. In case if you don't have traction, if you have a POC, then you need to have a letter of intent. That should be followed by market analysis or competitive analysis as well. Market analysis in terms of size of the market, scope of the market, how much can you capture. Competitive analysis in terms of who are your nearest competitors, direct and indirect, and how you are better than them. Then you can have like a one-page view of your team, their profiles, what have they done thus far, essentially answering the question of why is this team the best for taking this product or taking this startup forward. And then the last one is assumptions and roadmap, right? So what have you assumed thus far? And if given the money, then what are the things that you're going to do in the future as a part of your product or sales or growth or whatever the case may be, right? So here are some of the assets that you need, and we've done separate webinars on how to design your pitch deck, how to create financial projections, which I think can be linked after this webinar is over. But here are some of the things that you definitely need before you start your outreach. Another thing that this also does is that it pushes you to think think answers about questions that you've not yet thought about, right? So that's also an interesting journey into your own startup. The second is, what is the pitch, right? So typically, we believe that we want to talk about the problem, how it is being solved today, our solution, our team, competitors, X, Y, Z. However, depending on who you are pitching, you need to know what your pitch should be. So just to give you a very quick, simple example, if you're raising, let's say 1 crore, that is something that's likely to be fulfilled by 3 or 5 angels. And so the answer of what they want, these angels want, is a good exit, right? However, if you're pitching for, let's say, 6 crores or 15 crores, then you're pitching to likely an analyst of a VC firm. And for that analyst, a good exit is not necessarily true, right? For that analyst, what he needs to do is to find a stellar good startup, right? Which will essentially relate to their promotion a couple of years later, right? So a good exit is not necessarily the correct answer to why should an investor invest. So you need to know who's the investor persona, and then figure out what should be your pitch in terms of the investment that you're raising, apart from the product that you're building or the startup that you're building as well. And the last one is that if introduction is not possible, then try and build connections, right? So stalk them across all of their social media profiles, see what they talk about and they care about most, perform activity on that in terms of not just like blindly liking like a bot, but commenting on them, asking them genuine questions about whatever it is that they are posting, whether it is political, whether it is startup oriented, technology oriented, whatever the case may be. As long as it is appropriate for it to be in the public forum, you engage with them over there on those platforms so that you start getting noticed, right? And post that, you can initiate your outreach. So these are the 3 key things that are absolutely required before you start reaching out. So first is the assets. Second is the building the connections with people. And the third bit is knowing what is the pitch that you're going to take to the market, right? So now that we've got these prerequisites out of our way, we'll actually move on to some basic outreach and related activities. So the first is writing personalized emails, right? So a lot of times what happens is, one of the things that we do is we create a list and we try and do a mail merge, and then with the hi F name, I've heard a lot about VC firm name, XYZ, right? So that's how your emails begin. Most of the emails that they receive begin much like this. And so what I recommend is actually going through that investor's profile, finding something that they care about and commenting on that in the email that you write, right? Because that gives the personalized touch to those emails. So, and another thing that I recommend is, in any email that you write, do not send pitch decks right away, right? So ask them a couple of key questions see if they're interested in investing in your domain. So as an example, one of the gentlemen was saying that they are into AR/VR, right? A lot of investors may not be comfortable investing in such deep or very new technology. So there's no point in pitching a SaaS company investor to invest in an AR/VR company. So we need to understand what they want to do, what are their mandates in terms of investments, and then write personalized emails, right? The second is if you know someone, then get them to introduce you to the investor. This works like a charm, right? Every introduction that is made by a credible entrepreneur, it will always garner a response, right? And that's a very key thing. And then the third bit of, in case if you do not have email IDs, in case if you do not have folks who are able to get you those introductions, then the third bit is just to search, just, you know, even if you search on Google saying top VC companies in India, you go through like the first 10, 15 articles. I think eChai also has an article on that. So go through the first 10, 15 articles. You create a list of these VC firms that are investing in your domain. Go to their website, go to their team page, find the analyst who actually looks after the sector that you fall in. So if you fall under SaaS, if you fall under AR/VR, if you fall under AI/ML, NLP, if you fall under IoT, whatever it is, find the analyst who actually looks after that sector, reach out to them on LinkedIn, send out a request, and then get on a call. Now, it may sound like a fairly long process. However, it's just one single Excel sheet. And secondly, this is the way that I have seen work best for me. One of the reasons being that the analyst's core job profile is to find interesting stuff, right? So even if you're not interested, if you're not good, the least that the analyst will do is at least get on a call with you, right? And offer you feedback. So that's another thing that I definitely recommend that you do. So just some basic outreach activities that you could do. However, when you're doing all of these outreach activities, there are certain thought processes that I would want to talk about very quickly, right? So these are some of the hacks that help in enriching the outreach activities that I mentioned in the previous slides. And we'll go through all of these one by one, right? In the following slide. So first is that you should always create profiles, right? So before you start reaching out to the investors, sign up on Let's Venture, Angel.co, F6S, and apply to as many competitions as possible, right? So create and have a prolific startup profile page, so that if and when they do a Google search, your profile pages come up and they are able to very quickly consume bite-sized information about what your company does, and then initiate a quick outreach in case if they are interested, right? Not being present on these platforms essentially hinder a lot of outreach that could happen from the investor side to you as well. The second thing is that see if you can try PR, right? So almost every major startup platform in the country, including Your Story, Inc42, Tech Circle, VC Circle, all of these have a form on their website saying that we'd like to cover startups, or we'd like to do stories on startups. So apply to get covered on these platforms and mention what you are looking to raise publicly, right? So Devex is a great example. Devex is a co-working space based over here in Ahmedabad. One of the things that they did was, in announcing their fundraise of $1 million, they also said that they are looking to raise another round of $3.5 million 6 months later, right? So what this does is that a large number of investors now who look at or read through Your Story Inc42 now know that there is an interesting co-working startup, and they are also looking to raise a round of fund as well. The third is so this sounds a little bit counterintuitive, in the sense that your goal is not to right away get a yes, but your goal is to get a no. So in India, most of the investors do not say no. They just not say that they are not looking to invest in a company like you for whatever reason, right? So they just, what typically ends up happening is that you keep on following from them, and then it just fizzles out, right? So do not let it happen. So ask them for a decision, force them to reach back to you and say no, right? If they're not comfortable investing at this point of time, then ask for a no, right? And there are different ways of asking for a no, which we can cover in a later webinar. But this is something that I would, so this is basically a scientific method of going about it, right? So making an assumption that the investor wants to invest in your company, and then trying to prove that assumption wrong, right? So do each and every activity that will prove that wrong. The fourth one is, and this is something that I would recommend to everyone. So go out there and pitch all the time, right? So in Ahmedabad, there's at least one pitch event that happens every month. May it be happening in some co-working space, or eChai organizing some, or CII, or some of the other incubation center. So there's at least one event that happens every month. And so what I would recommend is that you can go to all of these events in and around your city and attend them and network and find opportunities to pitch there as well. And so pitch as much as possible. It does two things. One is that everybody knows that this is a person that exists, or this is a startup that exists. And secondly, it helps you in bettering your pitch as well. In terms of looking at the questions at the end of the pitch, you know what is working and what is not working as well. The fifth one is that follow up on your ask. A lot of times, so this is by far the most important thing. What ends up happening is that you reach out to the investor gets back to you, then you try to schedule a call, but for whatever reason, 2-3 weeks later, the call does not happen because someone starts traveling. However, you stop following up, right? So do not do that. So keep a target of sending at least 13 follow-ups until you receive a response, right? I mean, do not keep on following up if you've gotten a response, but until you get a response, keep on following up, right? And you've got to be absolutely, while the conversation or the language in the email has to be supremely polite, you've got to be absolutely shameless about following up with investors, right? That's downright important. And the last one is just finding partners. So there are a lot of service providers out there in the market. One of them that comes to mind is India Biz for Sale, that helps startups in raising a round, right? So, and against which they charge either a small part of your company's equity or a small part of success fee on top of the investment that they've raised. So as an example, they could charge you, let's say, 3% of the round that you raise. So if you raise 1 crore, they'll charge you 3 lakhs, right? But that is only on success. So see if you can find partners around who already have networks. The other partnership modes over here are also that you can look at angel funds. So there's our ventures, which in and of itself is a group of angel networks. There's venture catalysts, and so on and so forth. And so you could reach out to them as well and ask them to let you pitch in front of their angels as well. So the last bit that I want to share with you is that you only need one yes, right? So once you start raising a round of fund, your life will be about hearing no's and different reasons why they are not looking to invest. Some will say that some might say that you are too early for us. Some might say that your market is not too big. Some might say that there are a lot of competitors, and so on and so forth. However, you only need one investor to say yes, right? Every other pitch is essentially going to teach you how not to do it. And so we can essentially learn from it. And so as you might have guessed in the presentation thus far, that fundraising essentially ends up becoming a full-time job for at least one co-founder, right? And so do not take this up as a side activity. Take this up as a proper full-time job where essentially, much like selling your product, over here you are selling equity in your business, and then you can take it forward. So I think that's it from my side. Here's my contact coordinates where you can reach out, and I'd be happy to take up any questions if there are.
Okay, awesome. Thank you so much, Yash. This was very useful. While giving this presentation, every time also you improved your presentations.
Yeah, thank you.
So the practice of pitch, practice of webinars.
Yeah.
So yes, one of the thing to incentivize people to ask good question, we have guests to announce some sort of a rewards. So what is the reward you will give to someone who's going to ask good questions?
Sure. So my reward is the same. Basically, either of these two things. One is if you find that there's some value that I can add to your startup, then I can grab a cup of coffee with you. The coffee is on me. We can talk about your startup, and if there's any help that I can offer to you. So that's one. Or in case if I might not be that relevant to the field in which your company operates, then 2 weekday movie tickets to PVR. So these two.
Awesome. So if you're not from Ahmedabad, you can take this offer from Yash.
Yeah.
Awesome. So friends, you can ask questions in the chat. So it will be more efficient, because if somebody tries to speak, it will take a lot of time. I'll continue asking questions to Yash, but you can ask questions in the chat. We will read it out and ask. So Yash, which are the resources that you found useful in your journey of raising funds in terms of reaching out to investors? You mentioned some of the networks and some of the websites. So can you just elaborate more on that?
Sure. So a couple of things so there are certain tools that help you in digging out information. So as an example, whenever I was doing cold outreach, one of the things that I would do is I would use a combination of LinkedIn and any leads. So any leads is basically a LinkedIn scraper. So you buy a LinkedIn Sales Navigator, put in your persona of the investor, and then let Leads do its job. At the end of the day, it will give you anywhere between 100 to 150 odd email IDs of investors, and this is for the angel round that we did, right? And then we would do a cold outreach to them over email. So that's one. Second, I think we also had referred to one of the articles that eChai had written in terms of what are some of the who. So there are two things. So one was who are some of the most prolific angel investors in India, and then the second was which are the top VC firms or VC companies in India. So that is the second thing. The third thing, I do not have the link to that right now. However, one of the startups who had raised close to about $1 million from a group of 50 or 60 angels, they had written a blog as to how did they go about it. I think it was Ad Pushup at the time. So if you just search, Ad Pushup fundraising story, then they've in very detail they've highlighted what were the steps that they took. So that was another. It was on Medium, I think, and so that was another good thing that helped us out.
Okay, there are a lot of good questions. Sumit Gera has asked this question: at what point of the product development lifecycle you should start thinking about approaching an investor?
Oh, that's an awesome question. So just one sec. I'm just searching for the article. Yeah. So I would recommend that you should start raising funds on day zero, right? So as soon as not expecting genuine interest from the investors, not expecting that you will actually receive funds. I think the best time when you start receiving funds from or start receiving serious interest from investors is when your product is in the market. There are a couple of paid POCs in case of B2B companies. There are a couple of paid POCs that have happened, and you are starting to see some traction, some growth on a week-on-week basis is when serious interest would come in. However, as soon as you have an idea, I'd recommend that you start raising your round of fund, and that is because of two reasons, right? So the first reason, the first core reason is because it would help you answer questions about your idea that you've not yet thought about, right? So when you actually start to create your financial projections or your pitch or your all of those things, you start asking yourself some questions that you did not consider when you just had the idea, right? So that was one. The second reason why you should start doing that right away is to start building relationships. So if you want to have the money in the bank today, then a good time to start raising is at least 6 months earlier and 6 months before, right? And if you already have relationships built with investors by that point of time, in terms of pitching, in terms of meeting with them, then it just helps you get there faster as well.
Okay, awesome. Supreet has asked two questions. I'll read out the first one, which is a very good one. How to approach a VC or investor who has already invested in the similar domain? Or what do you suggest? Should he approach them or not?
So approaching them actually, so I'll tell you what. So the genuine probability of them doing a similar investment. Okay, here's where I'm coming from, right? When you say domain, it's very broad, right, as a word. So as an example, SaaS is a domain. VCs have portfolios of SaaS, right? So that's one way to look at the word domain. The second way to look at the word domain is let's say a taxi aggregator, right? So SoftBank is not going to invest in another taxi aggregator, as an example, right?
Which they did actually.
Which they did. However, most investors would not. SoftBank is an exception in most cases. However, but so if you mean when you say domain, if you mean the taxi aggregator kind of domain, then what I would recommend is you still should reach out to that investor and let them say no. So you should reach out with very low expectations and then see what they have to say, right? More often than not, they would have some kind of non-compete or some kind of an NDA with existing portfolio company in that domain, and then they'll not be able to take it forward. However, from the kind of questions that they ask you, you get a lot of insights.
That's a very good question. And so one more thing, every Wednesday evening, we'll have an investor perspective series. So every Wednesday, we'll bring in some investors who invest in startups to share their perspective. So Harsh has a question. My question is whether investors prefer a group of co-founder over a solo founder. How significant is the team for investors?
So absolutely. I mean, an investor will always prefer a group of 2 or 3, in some cases even 4 co-founders, than having a solo founder. It's just a matter of preference, right? There are companies where there are solo founders, where investors have still invested money, so there are going to be exceptions always. However, the preference always. So let's say if there are 2 startups who are equal on every level. An investor will go ahead with a company that has founding team rather than one co-founder. The reason being that when you have a founding team, your risk is mitigated as an investor, right? So my investment is not living or dying with the individual, right? So that's one thing. There are a couple of other things as well. If you have multiple people on your team, then that is the opportunity for your team to be as diverse as possible. So if I can give Gridle's example. I come from financial services background. Anupama comes from technology background, and Abhishek comes from design background. Right? So all the 3 of us. So I was into sales of financial services. So I was able to. So I'm able to take care of sales. Anupama is able to take care of product development. Abhishek is able to take care of design. So let's say tomorrow, if all 37 people who are there in the company, apart from the 3 of us, if all 37 people leave in a day, at least the 3 of us are still able to run the company, however slowly, but we're still able to run the company, right? So that's a way that they mitigate their risk as well.
Okay, Supreet has another question, which has kind of 2 questions. How to size the market if the problem doesn't have much of information online? How do you do the market sizing?
So
at tech industry.
Great. So I'll tell you what. So a way. Okay. One is that if you tell me that my market is $1 billion, I can have 1,000 questions which will prove otherwise. However, if you tell me to tell you what the market size is, I'll not be able to. Right. So this is that kind of a question where whoever gives the answers will only raise more questions. However, no one has the correct answer. So what you are looking for is not the exact true or correct number. What you're looking for is a fairly defensible thought process. So a good way that I go about it doing market sizing for a product or for a company is assuming if everyone who can buy your product buys your product, right? This is in case of scalable businesses, not in case of services. So if every person or company that can buy your product buys your product, then what would be your annual revenue, right? And then that would be typically your market size. So as an example, for Gridle, we are targeting agencies that are between 5 people to 20 people, right? Now, obviously, agencies more than 20 people can also buy Gridle. However, they are not my primary target market. So if every agency across the world between 5 and 20 buy my product, which is priced anywhere between $9 to $49 per month, then what would be my annual revenue? And then that is my market size.
Okay, awesome. There are a few more questions. Lawal has asked, I would like to know what to look for while selecting an investor.
Just one sec. Sorry, can you repeat the question?
I would like to know what to look for while selecting an investor.
Oh, awesome. So one of the things that I would, so it depends. So let's say if your company is not strong on a certain aspect, you may want the investor to be stronger on that. So the investment that you're raising is essentially, and this is true only for angels, right? VCs are all the same. So obviously they have different reputations in the market. So as an example, I'd value Sequoia Capital over Safe Capital. However, they behave in the same way with you, right? So there's no difference between let's say $1 million from Sequoia versus $1 million from Safe, apart from their portfolio companies and the size of those companies and things like that. However, in terms of if you're looking to select an angel investor, a couple of things that might come in handy is how much does the investor actually care about what you are trying to build? Is that investor only trying to hedge their bets in the sense कि 1 crore रुपया पड़ा है तो 10 lakh रुपए the startup में we are going to invest? Is that the thought process, or have they ever previously invested in your domain? Do they have a handle on the metrics that you should measure to figure out whether your company is growing correctly or not, or in sustainable fashion or not? And then the last thing that I would like you to see as a quality in terms of selecting the investor is if they believe enough in the team that you guys are, right? So in the sense, how much can they go out of their way to be able to help you reach wherever you want.
Okay. Jai Sriram has asked, our company is into IT staffing and corporate training services provider. Would investor invest in similar company?
So there are investors who will invest in companies that are into offering services. TCS is a services company. It's a publicly listed company. There are a lot of investors that they have. So people invest. However, the traditional term in which we talk about in terms of startup investing, I would argue that you might find difficult to raise from a startup investor. The reason being that a services company is typically not a scalable company, which means that which essentially means that the amount of input that you have to put in is going to be proportional to the output that you can generate. So if 30 people can work on 10 projects, you'll have 60 people to work on 20 projects, which is not true in case of products. So startup investor in its traditional sense will not invest in a services company. However, there are other investors who will invest in services companies.
Yeah, so that doesn't mean that you'll not find the investors. Sometimes it will boil down to your convincing abilities and how much you are able to sell your business.
Correct.
There are a lot of services business who are able to get investors.
Absolutely, and so there are scalable ways of running services business as well. So the key word that I'd like you to look for. See, the thing is, I know a lot less about your company right now, right? Just one sentence or one question. So what I would ask you to do is if you can spend some time and figure out what the scalable aspects about your business. So the key they are to invest in scalable models. So if service is scalable, then like example, step one. Challenge is if we tell big plan, it is confusing and investors lose interest. But if we just tell the part of the plan that they don't get the complete picture or the whole idea. So Gaurav, this is a great question. So a lot of times, what happens is we want to share the complete picture with everyone. However, that might not necessarily be true. So the idea of sharing with the investor, specifically in terms of the pitch that you are making, is to just generate enough interest for you to have a follow-on conversation with them, right? It is not necessarily to share the whole vision, mission. We are going to have 10 different suites of products which are going to serve different sectors and X, Y, and Z. The idea is that I want 50 lakhs today, or I want 1 crore today. So my company can build this one product, bring it out in the market, and serve 1,000 customers at the end of year one, right? And so what are the activities that you want to do with that 1 crore in financing? So I would strongly recommend that you do not share the complete picture. You assume that it is just one product that you are working on, or one stage that you have in your organization, and then that's pretty much it, right? And then slowly have them. So there's another thing called cognitive load, right? So if in 15 minutes or 20 minutes or 30 minutes that you have with the investor, if you are going to talk about, if you're going to explain your business for like half of that, then it's not going to work. So the explanation needs to happen in like 10-15% of the time, and then the rest has to be Q&A, right? So as an example, even this webinar, I felt that the presentation was too long. It should have been shortened to like 10 minutes or 12 minutes, and then the rest of it should be Q&A, because the longer the one person talks, the people start losing interest, right? Because short attention span and so on and so forth. So yeah.
Okay. Dharm has asked a very good question. What is exit strategy if startup fails? So then this question is for startup or for investor? But yes, you give answers from both the sides.
So I'll tell you what. So if the startup fails, you don't need to have an exit strategy, right? So exit is by default. So
you need to have a life strategy in that case.
So you need to have a backup plan or a professional career strategy. So if the startup fails, and which could be a very real scenario, then Startup India or DIPP. If you have DIPP certificate, it becomes very easy for you to fold down operations and move on. So yeah.
So same. Yes, but typically a lot of investors ask for exit plan. So typically, how do startups communicate? Because initially, when they are trying to build a startup or pitch their startups, वो company बन क्या रही है वो figure out कर रहे हैं.
Correct.
Yeah, how do you envision that and what will happen? So typically, in your case, what you did or what would you recommend?
So I tell you what. So one is I agree with you that in the initial stages of the company, and not necessarily initial, right? So I'm sure eChai is evolving even now. Gridle is evolving even now, and so our company will be, as you might already know, we named our company as Pivoting Softwares, right? Because we keep on pivoting. So there's obviously, it's a journey of self-discovery, right? So so absolutely true. The thing is, you know that, and I know that as a founder that we've not yet arrived to an exact vision or mission, right? The investor does not know that, and it's important to know what the other person doesn't know. And so when you are selling something, even though you may have an internal insecurity or you may have a question on what you are saying, but you've got to say that with super confidence, right? Okay, this is what we're doing, and this is what we'll be able to do. These are the metrics which tell me that I've failed, and if I do, then I'll move on to something else. So that's one. And second is, in terms of whenever an investor asks for an exit plan or an exit strategy, it means that it is not a VC, right? If VCs typically do not have such questions because they're mature enough to. So if they see an exit strategy in your startup is when they'll actually go ahead and invest, right? So this question typically ends up being asked by family, friends while around, or in the angel round. So a good way to answer this is that if I am able to raise funds today, right? So if I have 1 crore from you today, I'll be able to grow my startup to 4x in the next 1 year by doing these 5 activities, which could be in terms of product, marketing, X, Y, Z. At the end of this 1 year, I'll raise another round of 3 crores, which will help me to grow my startup another 5x, right? So essentially, and these are just random numbers that I'm throwing at you, right? So you need to work out what they would be as per your financial projections. So essentially what you're showing is that at the end of 2 years, your company would have grown by anywhere between 20 to 25x. The couple of options that you have is that at the time, you can offer them a secondary sale. So you can say that, okay, I go out and look for another investor to buy you out. And the other option is obviously going ahead and raising a fund from VC, where they could again buy these investors out and clean the capital.
Okay. Shweta has asked a very good question. Are investors more inclined towards equity or debt now? How feasible are ISAF agreements for a startup?
So, great question. I'll be honest with you. I do not know the answer to this question. So, sorry. I do not know what ISAF agreements or ISAF notes are.
Okay.
Because we've, I've heard that. I know that a prolific investor called Sanjay
Mehta from
Mehta.
100x VC.
So Sanjay Mehta from 100x VC, he does ISAF notes. However, whatever rounds that we've raised have been straight up equity investments that we've done. And even though I have like some idea of what they are, I'll not dare to like just say random stuff. So I do not know the answer to that question. I'll figure that out and I'll let you know.
Okay, we had Sanjay Mehta at one of our sessions in Ahmedabad at Vibrant Gujarat Startup Summit. So we'll reach out to him to understand more and the founders who have availed that kind of a services.
Yeah.
Lawal has asked, while raising funds, how do you decide the portion of the equity to dilute and how to value the equity portion?
Sure. So basically the way the way to go about it is so I'll tell you a method which is essentially a very crude version of discounted cash flow, right? So the way that I would look at it is that how much. So what are your next milestones? So in the sense, let's say I have a product today and I have a team of 3 people who are working at like 15,000 rupees per month, right? Then my next milestone is to grow the team to a 10 people team within a year, to build, let's say, 5 features in the product, to acquire 100 customers who are paying me, let's say 1,000 rupees a month or 5,000 rupees a month. So I'm at 5 lakh in monthly recurring revenue, right? So let's say that is my next milestone. Then to achieve my next milestone, these are the X activities that I will have to do. So one is I'll have to recruit more people. Second is I'll have to invest in marketing. Third is I will have to let's say, build the product and conceptualize it, do some research, and it is going to require this much amount of capital. Now, so then the next argument in front of the investor is that if I have this amount of capital, I'd be able to reach this goal. You discount this goal even by 20%, then I want to give you a 3 to 4x return on whatever you invested in today, right? Because this is my future value, which is for next year. So let's say if a year later my company is going to be valued at 10 crores, today I want you to value my company at 2 crores or 3 crores, and hence you give me 30 lakhs, so which is 10%. So that is a very, very crude way of discounted cash flow that you can implement. But more important, this is interesting because me and Srijay were having this exact same conversation earlier today. So the bottom line is that valuations at an early stage are more of an art than a science, right? So that's basically where.
And this brings me to the plug for another webinar. So we'll be doing an understanding term sheet. So we'll go deep down on some of the things, but by that time we'll also have more understanding about ISAP norms.
Yeah.
So Smith has asked this question twice, Yash. So you have to really give a very good answer to it. If you can read it out.
Sure. Just one sec.
Sharma.
How do you build a high yet reasonable ask for a B2C tech company that also has B2B2C marketing strategy? What elements are absolutely necessary to be included in the financial projections associated with the ask? All of this will boil down to the metrics that you measure, right? So there's a VC firm in Delhi. I mean, it's a global VC firm. They have an office in Delhi and Bangalore called Lightspeed. Lightspeed is super simple. So they measure daily active users. So if you have 10,000 daily active users, which is very possible for a B2C tech company, that's when they'll seriously consider it, right? So daily active users is what their metric is. Let's say for a SaaS company, it could be the amount of churn or ARR or MRR. For some other company, it could be the amount of partners that you have or the gross, so GMV that you may have, and so on and so forth. So the idea in financial projections is to anchor yourself to another company in your domain and figure out what their valuation could have been at that stage, and then try and get to that stage. Right. So to give you a very simple example, let's say if you're starting a marketplace that's fairly similar to Urban Clap. When Urban Clap had 10,000 daily active users, what could have been their valuation, which you'll be able to figure out if you do a little bit of research on Zoba or on MCA as well. And then what is it going to take for you to get there? And then that's essentially how you build your high yet reasonable ask.
Okay. Pradyuman has asked a very good question. So I had been asked by an angel, why do you need money as an investment for marketing? Could you tell? Could you tell what's your take on this? Also, people say investors typically won't invest for marketing. This is with reference to when my pitch had 40% share on marketing as expense. Also, I wanted to understand how does valuation is done for a startup? That's a question I've been asked. What is your company's valuation?
Yes. So here's an answer, right? So I'm assuming that Pradyumna, you're building a technology company, right? So if you're not doing something that is drastically different, then technology for you and for me is a commodity, right? So let's say if you're building a SaaS product, much like how you can do it, I can also do it, Jatin can also do it if given the right resources, right? So technology is not going to be an entry barrier. The only thing as a technology company is going to be an entry barrier for someone else to enter is the amount of customers that you already have, the momentum that you've already built. So as an example, if you go to any services company which does web and mobile apps, and if you ask them, hey, I want to create a WhatsApp clone, they'll sell you that for like $5,000. So technology to hai, one-on-one chat or one-to-group chat, much like exactly like WhatsApp, technology is already there. $5,000 you'll be able to get. The only thing that stops you from doing that is that there are 1.5 billion people who are already using WhatsApp, right? So the only thing that is your entry barrier is the amount of customers that you have, and the only way to achieve those customers is through marketing. So this is I don't think that this is correct. If the investor is saying that I'm not going to invest in invest in marketing, I'm not sure. I mean, why? Because if you are a growth investor, marketing is a great vehicle to achieve growth, right? So that's one.
So his question was, some folks say that. So what you are saying, those who are genuine investors, they probably might not have that question.
Yeah, so move on. I mean, so there are a lot of other investors. If an investor is saying that I'm not going to invest or let you invest in marketing or invest in your marketing, then you can move on. If you believe that marketing is important, you move on to the next person. That's one. Second is, whenever someone asks you what's your company's valuation, a great way to respond is that it's a buyer's market, right? So I can have an expectation of valuation. However, my valuation will be decided by the person who buys equity or the company that buys equity into my company, right? So I cannot say what is my company's valuation. My expectation is X, Y, or Z. Right? So another thing that I would recommend is, instead of saying your company's valuation, a better way to go about it, which is essentially the same thing, it's just indirect way to go about it. A better way to go about it is to say, I'm looking to raise 1 crore and to dilute anywhere between 6% to 12%, right? Or 5% to 10%. What this means is that your valuation, while the difference between 5% and 10% is only of additional 5%, your valuation now ranges from 10 crore to 20 crore, right? So if you say that my valuation is anywhere between 10 crore to 20 crore, it is not perceived correctly. However, if you say that I'm looking to raise a round of 1 crore for anywhere between 5 to 10% dilution, it is taken better. So that's what I'd recommend.
Okay, Pratibhan, if you have any question, probably we are towards the end of it. You can get in touch with Yash later on. We'll take last two questions. Ashutosh has asked, any suggested model which can be used for arriving at a fair split for equity between co-founders? Concern is that majority shareholding remains with co-founders till Series A. And how much should be carved out for ESOPs?
So there are so it depends on how the company has been structured thus far. So the best way to have a fair split between co-founders is to figure out what is the impact that each co-founder will have on the company over the next 5 years. That is one factor. The second factor is to figure out what is their opportunity cost. So as an example, when we started Gridle, I was already doing a job that was paying me good amount of salary. However, Abhishek and Anupama, since they were 1 year younger to me, they were not at a job. So my opportunity cost was higher. And so I ended up getting a little larger than what they got within this organization. Another thing that you may want to think about is think of your company as a separate person, right? So I would think of Gridle as a fourth person who is now evaluating. Can I get a better CEO for cheap than Yash, or can I get a better designer for cheap than Abhishek, or can I get a better CTO for cheap than Anupama, right? And so if Gridle is trying to make that decision, then how would that split come, right? So that would kind of make it a little bit easier as well. However, this is also more of an art than science. The next one is that majority shareholders should remain with co-founders. That has nothing to do with the fair split of equity between co-founders, right? So if you have 40-30-30, or you have 50-30-20, whether the majority remains with co-founders or not till Series A has nothing to do with that, because all of you guys will be proportionally diluted. So even at 40-30-30, you may end up with 76, or at 50-30-20, you may end up with 76 ultimately after dilution, whatever the case may be, right? The last bit where you said how much should be carved out for ESOP. So this may be an incorrect answer, but I recommend a blanket 10%. But it genuinely depends on what are the, so as an example, if you're building a research-based company where you're going to need a lot of PhD people contributing to your algorithms and stuff, you may want to carve out a little more in terms of ESOPs. However, if you're building a company that is a very simple, so much like Gridle, right? A very simple SaaS product. So we don't need like super intelligent folks who are going to charge a bomb out there in the market. Then it could be reasonable 8 to 10%.
Okay, awesome. Yash, which question was good?
I think the question that I liked the best was the question that I was not able to answer, which is about iSafe notes. So I'm not sure who asked the question, but so what I do is I mean, depends on the reward that the person is going to look for. But yeah, so that was.
Shweta is online. Shweta had asked this question. She was one of the speaker for our Mumbai event last time.
Okay.
Awesome. So I'll do some couple of eChai announcements. So friends, all of you are registered on the eChai website. You will be able to see typically if you register, if you're a member, you'll be able to see these links, or if you take up a one event pass. Probably tonight we'll have this comment feature live. So if you have any further questions around this topic, you can ask this question, which will basically send an email notification to our speakers. In this case, it will go to Yash. We will be updating the event notes. So I'll be uploading the event video tomorrow morning here. Also, the presentation that Yash had shared, the link is here. Also, this is important. If you can complete your eChai profiles and if you can write about your motivations, then this page will become a very nice one where you'll be able to discover who else was in the webinar. And so probably immediately might not help you, but probably a month down the line, you happen to travel to a university and you would need something, then this information can be very, very valuable. We have a lot of other, so with Yash, we are doing a series where we have a lot of interesting topics. Tomorrow also we have a session around creating effective Facebook and Instagram ads. So a lot of interesting things going on, and we will have a lot of other interesting things. So if you want us to do something very specific, you can also let us know. We probably can take that on. And with this, we are finishing on time. So thank you so much, everyone. Yash, any closing remarks, any suggestions that you would want to give to the folks?
Yeah, so just one quick thing is I think Hriday has already shared the same article that I was referring to from Ad Pushup. So you guys can go through that. It's a little old now. This helped us in, I think, 2016 or something like that. However, so a closing remark would be that all the questions that we received were not about reaching out to investors. But essentially, they were about how to deal with investors or internal equity or valuation and so on and so forth. And so I think we can, from the questions, we can take a cue and probably kind of have a different set of webinars which could be in and around these questions as well. I found these questions supremely interesting and great to answer.
Yes, for sure. We'll do something on those lines. So thank you so much, everyone. With this, I'll just close the meeting. Thank you so much, everyone.
Thank you.